Alright everyone, Cowboy Trades here, welcome back to the channel. So it looks like we've got some new Fed commentary that I do want to go through with you today. After, of course, we had the CPI numbers come in hotter than expected. We've had Fed officials, Fed's Logan, Fed's Williams and Fed's Harker come out. So let's talk about their commentary, starting off with Fed's Logan in no particular order. Fed's Logan said tightening policy too little is the top risk. We must be prepared to raise the interest rates for a longer period of time than anticipated if necessary. And Logan also said, I expect the Fed to continue reducing its balance sheet for a fairly long time. Now, I know a lot of you maybe not know the effects of the Fed balance sheet in comparison to your equity markets and Bitcoin. I've talked about this before on the channel, but basically with the Fed balance sheet, when the Fed balance sheet goes to the upside, you can see, a monumental increase in the balance sheet. This caused a huge run up in your equity markets and Bitcoin. And you can also see over here the top in Bitcoin in the equity markets. While this doesn't correlate to the exact top for the Fed balance sheet, it more or less correlated to the top before rounding over and breaking down. Now, if we are moving this data point over to where we actually topped out round about March, what you can see is the Fed or the central bank balance sheet has been decreasing since this moment of time. And as you can see, this decrease in the balance sheet actually correlated to this top in the equity markets and this top in Bitcoin before that major meltdown to the downside. So just wanted to explain the balance sheet. But moving on from there, once again, in no particular order, Fed Williams said for a while the Fed will need to maintain restrictive rates. The Fed has yet to raise interest rates to where they should be. Recent data supports the case for additional rate hikes, and he is obviously talking about the most recent CPI numbers that came in hotter than expected, like we discussed over on the channel. Both core and year-over-year inflation. Well, core CPI had a big jump to the upside, and year-over-year and month-over-month headline inflation came in hotter than expected. Williams also said the Fed still has a long way to go in terms of controlling inflation, and it will take several years to get inflation back to 2%. So, building on from this, Fed Harker said, I forecast 1% real GDP growth for this year before returning to 2% trend growth in 2024 and 2025. Coming back over to the hawkish commentary, Fed's Harker also said, we need to maintain this interest rate path of increasing the interest rates by 25 basis points a pop. Then Harker said, I do think that we need to continue above 5% in 25 basis point increments for a while. Obviously talking about the current United States Fed funds rates, also known as the interest rates, which are currently sitting at 4.75%. Another 25 basis points would of course put us up at 5%, and this is 1 month away in the next FOMC meeting, and Harker's saying that we need to continue with more 25 basis point increases for a while, which is in direct correlation to what Williams and also Logan has been saying. Coming over to the next commentary from Harker. Harker also said how much further above this 5% Fed funds rate we need to go depends on the incoming data. And of course, we've been seeing inflation coming in hotter than expected. And as we've been discussing on the channel, it's going to take a very, very long time to come back down to this 2% ratio. So for today, that's all I've got. As always, my friends, if you enjoy the updates and the Fed commentary, if you enjoy my content, let me know down below by leaving a like and a comment. Share the videos with your friends. And if you do want more of my post charts, memes, and economic data that doesn't make it over to my YouTube channel, be sure to follow me over on Twitter at 618_cowboy. But for today, that's all I've got. It's been your boy Cowboy Trades. I'm out. Peace.